Today I'm going to explain the statement of cash flows in a very simple way. This statement is going to be based on the cash basis of accounting. It's a simplified version. The statement of cash flows, contrary to the income statement, the income statement, remember, shows us how profitable, if the company, the business was profitable or not. However, the statement of cash flows answers a different question. It answers, did the business actually receive and use cash, and how much? A company can show a profit and still run out of cash. So this statement helps us see clearly where the cash really went. This statement shows cash inflows and outflows in three different ways. All businesses bring cash in and use the cash or outflow the cash through three main activities: operating, investing, and financing. Those are the activities that in which a business uses cash or bring cash in. All businesses. Operating activities include cash related to the day-to-day business operations. It's the day-to-day grinding and running the business, right? Examples include money coming in from cash received, money coming in from the customers for the sales of services and or sales of products. Cash paid is an outflow of money. Cash paid for rent, operating expenses such as rent, utilities, supplies, and you can imagine everything that goes on in a business on a daily basis. For instance, if a restaurant receives cash from customers for meals, that's operating cash inflow. If it pays cash to employees or suppliers, that's operating cash outflow. In this case, this is a service-based business. We're selling services, providing services to clients. Money came in and money went out. The second activity, and notice that they are always listed in the same order, operating being first, investing being second. Investing activities involve buying and selling long-term assets. And the long-term assets are defined as fixed assets. That's the accounting terminology. Examples include buying equipment, selling equipment, buying or selling buildings. If a business buys, for instance, new kitchen equipment and pays cash, that is a cash outflow from investing activities. If it sells old equipment and receives cash, that is a cash inflow from investing activities. In this business, they purchased land, so they used the money left the bank account, and sold the building, so money came in. The third activity is the financing activities. The financing involves cash related to owners and lenders. The cash related to owners is called equity. A business finances its operations either through equity or debt. Those two ways. So the business in this company is a corporation. As you can see, is issuing common stocks. It's bringing in shareholders. Shareholders give the company money in exchange of common stocks. Shareholders own the corporation, by the way, so it's the owner's money. The repayment of a bank loan, it's a way of the business using the money, using the cash. It could also be cash paid as dividends or cash paid to the vendors and or suppliers of the business, because the business might have purchased stuff on account before, and therefore creates an accounts payable, and that accounts payable, when it's paid, in this example we don't have an accounts payable, but that's one of the ways in which the cash is used. Now let's go to the operating example a section, and let's pretend this business brought in cash from sales to providing services to the clients, and it also paid for operating activities, operating expenses. Since the money that came in is larger than the money that went out, inflows larger than the outflows of cash, then this section, operating activities, has a net increase. Now in the investing activity side, the purchase of land represents an outflow of cash. And we are going to pretend that the company purchased land for $65,000. However, it brought money in from the sale of a building at $150,000. Therefore, the net increase from investing activities is going to be $85,000. In the case of the financing activities, the business issued common stocks. And again, if it issued common stocks, then cash came in, and the common stocks were $25,000. On the other hand, it repaid a bank loan, and the bank loan got repaid for $100,000. Let's just say $75,000. So again, the outflow is represented in negative to indicate that the cash is being reduced. In this case, notice that the outflow of cash is larger than the inflow. Therefore, we have a net decrease from financing activity, and that is $50,000. So we are going to now total the three net increases and or decreases and see what we come up to. So total here. Our net increase is $90,000. However, we're not done here. We still have to add the beginning balance. Think of this, again, this is a simplified version of the statement of cash flows. But think of it as a bank statement. You look at a bank statement, the bank statement shows a beginning balance. In this case, the beginning balance as of January 1st, because the statement is prepared as of January 31st, 2026. So the beginning balance of this bank account is going to be $30,000. Therefore, that statement, bank statement, is going to show an ending balance of $90,000 plus $30,000, $120,000. And that, ladies and gentlemen, makes up our simplified version of the statement of cash flows. Remember, operating activities has to do with the running the business, day-to-day activities, day-to-day doing, the busyness, the hecticness of running a business. Think of it as, you can see that in small businesses. There's a lot going on throughout the day. Those are operating activities that are constantly happening in the business. Sales to clients or customers, selling products or providing services, and money used to run the business. To make money, you have to spend money. That's how it goes. Investing activity has to do with the purchases and sale of long-term assets, fixed assets, and financing, lastly, is related to the owner's money common stocks in this case because it's a corporation. If it's a solopreneur, let's say it's a sole proprietor business, then we will have here the money that the owner brought in from his personal savings account or from emptying his 401k to start the business or to help the business grow. Then it leaves is the bank account, the cash, through financing by prepaying loans, cash, paying dividends to the shareholders, or paying the vendors and suppliers. So after we add up all of these net increases and decreases, add this to the beginning balance of the account, in our case the bank account, and ending balance, this will give us the ending balance as of the end of the month or the end of the year or any other time period that this statement is prepared for. And that's it for today. Thank you for your time.